All right, so entries to record cash dividends. So just a couple of things to, we'll take some notes here. We'll finish up our note sheet. Cash dividends are simply dividends of cash. Stock dividends would be dividends where they give you stock. And so if you issue a stock dividend, there's really no journal entry. There's really nothing to do, because really all they're doing is printing more paper and giving you more shares of stock. And so what we're going to look at here primarily is a cash dividend. All you have to do know between the two is that a stock dividend means that they're issuing stock. A cash dividend means that they're issuing cash. So, but we're going to focus here on cash dividends. And so there's a couple of things we need to know about cash dividends. Let me see if I can find my notes. There we go. A couple of important things for cash dividends. First, there's a couple of different dates. The first important date is date of declaration. And so this is the date that the board officially says we're going to declare a dividend of, and they're going to tell you how much, and they're going to tell you a couple other things, and those will relate to these other dates. So the next is the date of record. At some point, you got to draw a line in the sand and decide who owns the stock, because the stock might be getting bought and sold every day. And so you have to say, all right, we're going to declare a dividend, and maybe they meet on December 15th, and they say, okay, December 15th, we are declaring that as of December 31st, the date of record, everybody that owns stock at the end of December 31st gets the dividend. So the date of record is the date that they look out to see who owns the stock, because that's who they're going to write checks to. And they're not going to be the same date always. And the last one is the date of payment. All right, so maybe we have a December 15th, the date of declaration. We have a board meeting. We declare a $4 per share dividend, and we're going to pay it to everybody that owns stock as of the date of record, December 31st. We could choose any date we want, but for this example. And we're going to write the checks January 25th. And so what that would give us then is some time to figure out who are the owners of the stock, write the checks, and get them in the mail. And so the three dates: date of declaration, date of record, and date of payment. A couple other things for cash dividends. You got to have a couple of things. You got to have sufficient retained earnings. Okay, if you've got a business that's only had losses, you can't declare a dividend. A dividend, by definition, is a distribution of earnings, of previous earnings. Maybe you've had profits, but you've had previous dividends that have distributed significant or mostly all of your previous profits. If you don't have retained earnings, you cannot declare and issue dividends. Second thing is you need to have cash. You can't declare dividends that you can't pay. So you have to have cash in your bank account in order to be able to pay the dividends. If you declare dividends and can't pay it, it doesn't even make any sense. You've got to be able to actually write the checks. And then the third thing is you absolutely have to have a formal action by the board. So maybe you own preferred dividends, and it states that you're going to get 7% dividends each year. If the board doesn't formally declare that they're going to pay that dividend, no dividend check gets written. Even though it says that it's supposed to, it still requires the action of the board. So those are the three must-haves. So let's go ahead and take care of some dividends here. 13.9. The declaration, record, and payment dates in connection with a cash dividend, important to note that it's a cash dividend, are 187.5 on the common stock. And so the dates are July 10th, 9th, and September 18th. So declaration, record, and payment date. Journalize the following for each date. So July 10th, that's the date of declaration. So as soon as the board votes that they're going to issue a dividend, now it becomes a payable. It becomes something that has to happen. They've declared it, they voted on it, it's done. So we're going to have a cash dividend and cash dividend payable. And you can use a lot of different words as long as it's a payable or a liability of some kind to show that you're going to be paying this. And so how much is this? Well, they've said that it's $187,500. All right, so the next date, August 9th, that's our date of record. So the date they're going to look out and see who owns the stock and gather all of the names and addresses. And so on this date, though, there's no entry. There's paperwork, but there's no accounting entry. Lots of paperwork to try to figure out who the names are, and probably have to have Social Security numbers to prepare all the tax reporting and everything. But there's no formal entry in the accounting record. It's just simply a lot of extra bookkeeping on the other side. Actually, interesting, maybe not interesting. Corporations, some will keep track of who the stockholders are internally, but some will actually hire other companies, and that's all their job is to keep track of who owns the stock and what their address is, because that's actually kind of a pain. If you issue dividends, maybe Pepsi or Coca-Cola issues dividends, there's plenty of people that have moved and didn't update the fact that they moved, and so then you get stuff sent back to you because there's nobody at that address anymore. And so there's a lot of busy work that goes into trying to get the dividend checks to the right people. So, all right, so in the last thing, September 18th, and this is our date of payment. So at this point, they're going to write a check, and so for writing a check, cash should be credited. So we're going to remove this cash dividends payable now. It has a credit balance. We're going to debit it. For $187,500. So this is going to have a zero balance now. And we're going to pay it with just cash. And before we leave this problem, just to review and make sure we're clear a little bit, though, the cash dividend payable is a liability. That's why it has the credit balance. A cash dividend is part of the equity section. It's part of the stockholders' equity. And at the end of the year, it's going to be closed out to retained earnings, or it might actually, to be honest, some people might not record this as cash dividend. They might actually record it as retained earnings, because that's where it needs to get to anyways, and both would be perfectly plausible. This is what you're going to see in Cengage, though, is cash dividend, but in this case you would be required then to close this out to retained earnings at the end of the year. So that's why some people would do the journal entry directly to retained earnings. So, all right, that wraps up cash dividends.